Here's something that might catch you off guard. If you're under 35, there's a real chance your net worth is sitting below $50,000. And that's not a personal failure. It's just where most people your age actually land. Most of the numbers floating around online are outdated, and that alone can completely change where you think you fall. Today, we're breaking down real numbers from the Federal Reserve, adjusted for today's dollars, so you can see exactly where you stand compared to everyone else in the country. Before we get into the numbers, there's one thing you need to understand, because it changes everything. There are a few ways to measure an average. You've got mean, median, and mode, and most people lump them all together without thinking twice. We're using median here because it strips out the billionaires and CEOs who would otherwise drag the number way up and give you a false picture. Median shows what a typical household actually has, not what the wealthiest group is sitting on. And here's the second thing. This is household net worth, not individual. So if you're single, your real comparison point is usually lower, closer to half of what you're about to hear. Keep that in mind as we go. My name is Nathan, and I spend way too much time thinking about how building wealth actually happens. Let's start where most people feel the worst, under age 35. The median here comes out to about $43,000, and for a lot of people, that number feels brutal. A huge piece of this comes down to housing. Most folks this age haven't bought a home yet, or if they have, they're only a year or two in, and early mortgage payments barely touch the actual loan. It's almost all interest at first. On top of that, plenty of people in this bracket are still carrying negative net worth thanks to student loans and credit card debt. So if you're young and your number's positive at all, you're already ahead of a lot of people your age. Here's a good way to think about it. Picture a guy named Derek who just graduated and landed his first real job. He's posting photos from a beach trip every few months, and it looks like he's thriving. But here's the strange part. Posting a vacation doesn't mean someone's wealthy. It usually just means they're spending. Don't compare your bank account to somebody's highlight reel, because you're only seeing the parts they choose to show you. Now things start shifting for the 35 to 44 group, where median net worth jumps to about $149,000. Part of that jump isn't even about earning more. It's about households combined. More people are married by this point, which means two incomes and two sets of assets get folded into one household number. That alone pushes the median higher without any single person actually getting richer. Add in the fact that this is prime time for first home purchases, and you start seeing real equity build for the first time. Careers are more established too, so paychecks are climbing. But don't picture smooth sailing. Mortgages, kids, and old debt all stack up right here, so a lot of that paper wealth gets eaten before it ever feels like breathing room. Move up to ages 45 to 54, and median net worth jumps again, this time to around $272,000. That's almost double the previous group, but it's less about a sudden windfall and more about two long timelines finally paying off: housing and investing. By now, homeowners are well past the interest-heavy years of their mortgage, so real equity is piling up quietly in the background. But the bigger driver is retirement savings, which more than double at this stage. It's not that people are suddenly saving harder. It's that money sitting in a 401k or an IRA has had decades to compound. Growth starts building on top of older growth instead of just new contributions. And that's when the snowball really picks up speed. This is also peak earning territory, so people tend to buy more too. Nicer cars, maybe a boat, jewelry, stuff that counts toward net worth on paper, even though it isn't really building long-term wealth. Then things level off. For ages 55 to 64, median net worth actually dips slightly to around $241,000. That might sound backward, but it makes sense once you look closer. Peak earning years are behind most people here, and some are already cutting back their hours or easing toward retirement. Less income coming in means less extra cash to aggressively grow wealth the way people did in their 40s. Investment strategy usually shifts too, away from aggressive growth and toward protecting what's already been built. Bonds start replacing riskier assets, and volatility gets traded for stability. Homes are mostly paid down by now, so there's less leverage doing the heavy lifting, and some people downsize, which just reshuffles equity rather than growing it. This stage isn't really about building anymore, it's about guarding what you've got. Ages 65 to 74 tell a different story, with median net worth climbing to roughly $451,000. Most people here are retired, or close to it, so new income from work slows to a trickle, maybe Social Security or a pension check. The growth you see now is largely leftover momentum, investments still ticking up in the background, even while people start pulling money out to actually live on. Some sell a big house and downsize, pocketing the difference and tucking it away. But that growth and those withdrawals tend to cancel each other out, which is why the jump from the previous group stays fairly small. It's less about earning and more about carefully managing what's already there. And finally, for anyone 75 and up, the number starts to fall. People are living off savings at this point, and healthcare costs tend to climb fast and unpredictably, quietly draining what took decades to build. Life events matter more too, losing a spouse, needing extra help around the house, or simply not being able to keep up with repairs the way they used to. Roof work, plumbing, general wear and tear, things that used to get fixed right away start getting pushed off. And that slow neglect adds up. It's not one single cause, it's spending outpacing income across the board, with fewer sources replacing what's going out the door. Step back and look at the whole picture, and you'll notice something. Almost none of this wealth came from some genius investing strategy. Derek didn't retire early because he found a secret formula. People buy a house because they need somewhere to live, not because they're chasing equity. They set up automatic contributions to a retirement account and mostly forget about it. Years later, compounding quietly did the heavy lifting. It's not glamorous, it's just consistency. So now you've seen where the typical household lands at every stage of life. Does your number come in higher or lower than you expected? And more importantly, where do you actually stack up? Please share this with a friend or two. Show your support and subscribe to the channel. It really helps, and it means a lot.